They told you this could never happen. They said the dollar was solid. They said the surge in gold and silver was just noise, a meme-driven spike, a temporary frenzy, something that would fade as quickly as it appeared. And yet here we are, watching cracks spread beneath the foundation of the world's most powerful currency, while the metals market refuses to cool off. Before we go any further, quick favor. I'm actively pushing back against copycat channels that steal content and recycle it without adding value. If you appreciate the work we do here, support the effort by subscribing and leaving a comment. I know what some of you are thinking. Sure, things look messy, but the dollar is still the cleanest shirt in a dirty laundry basket, so why would it fail now? Now, let me frame the situation. That's a fair question. And the answer trips people up every cycle. Currencies don't move based on who's best. They move based on who's deteriorating faster. If the US weakens at a quicker pace than its peers, the dollar can slide even while the rest of the world struggles. That's the trap most people miss. Think of it like a race. One runner is far ahead, but suddenly twists his ankle. The runner behind him is exhausted too, but still moving cleanly. The gap can close fast, not because one is virtuous and the other isn't, but because conditions changed. And right now, the US is dealing with 3 pressures simultaneously. That's how currency shifts happen. Not morality, mechanics. Markets don't wait for official rate cuts, they anticipate them. Once traders believe easier money is the default path forward, the dollar loses one of its strongest pillars, yield advantage. Second, refinancing pressure. When you're rolling over massive amounts of debt year after year, you're constantly dependent on buyers showing up. If those buyers start demanding higher returns, the system has 2 options: pay up or find another way out. Historically, the other way is a weaker currency. Third, confidence erosion. For decades, the dollar enjoyed a trust premium. Investors believed in the rules, the discipline, the predictability. When questions start forming about policy stability, fiscal restraint, and crisis responses, that premium slowly fades. None of this is a prediction of collapse. It's a pressure reading. And when pressure rises, metals usually respond before the headlines do. Let's also acknowledge something people feel, but rarely say out loud. Exhausted by narratives that constantly change. Exhausted by inflation being temporary, then persistent, then handled. Exhausted by being told debt doesn't matter until suddenly it does. They're exhausted. That fatigue matters. Because when trust erodes, people stop giving institutions the benefit of the doubt. And that's when minor technical breaks become sustained trends. In the last video, I explained a simple rule. Keep that in mind as we rewind history. Not for nostalgia, but for pattern recognition. Because the next few minutes will help you decide whether the move in gold and silver is just a prelude or the beginning of a full repricing that catches most people unprepared. Precious metals don't form lasting tops until the dollar experiences a genuine breakdown. Not a small dip, not a one-day wobble, but a shift that alters behavior. For months, the market fixated on $1 index level, 96. It acted like reinforced steel. Touch it, bounce, touch it again, bounce, test it repeatedly, and eventually you hear something snap. On January 28th, we finally dipped below that level. Intraday. And despite all the central bank talk about monitoring data, the dollar didn't look resilient. It looked worn out. Here's the key point. The dollar doesn't need to crash overnight for gold and silver to accelerate. It just needs to lose credibility gradually. The kind of decline where people keep insisting everything is fine until it isn't. Recent data confirms the pressure is building from multiple angles at once. Debt auctions, rate expectations, global capital flows that ignore speeches and slogans. That's why this video will cover 3 things. First, we'll revisit what happened the last time the dollar index fell from this zone and how gold and silver behaved during that period. Second, we'll discuss what lies beyond the next support level, the conversation most people avoid. Third, we'll tackle the question flooding my inbox. If silver is exploding, do you buy the metal or the mining stocks? And I'll be brutally honest about both opportunity and risk. Before we continue, check the description. I've added bonus links, including the premium WhatsApp channel and the channel membership option for deeper research and faster updates. Even if you ignore politics entirely, the math is screaming. Now let's address what the everything is fine crowd avoids. Federal debt has surged past $38 trillion and continues updating in real time. Combine that with refinancing needs, rising interest expenses, and increasingly selective buyers, and the system becomes hypersensitive to confidence shifts. When the central bank hints at cuts, that's not just a rate story, it's a currency story, because currencies trade on relative stress. If the US eases while others stabilize, the dollar loses ground. Some listeners heard the latest press conference and thought, they're going to cut. Others heard something else. They don't have many alternatives. That second interpretation is what pushes capital toward hard assets. At the same time, global money is rotating quietly. You see it in fund flows. You see it when the dollar struggles to rally even on decent data. You see it in how quickly gold gets bought on pullbacks. And you see it in silver, behaving like a market with tight supply and nervous participants. Silver recently surged past $100, reached highs north of $117, then snapped back violently. That kind of action fuels emotion. Bulls celebrate, bears declare victory, and everyone forgets the only question that matters. What's the underlying trend? Historically, gold and the dollar index move inversely, not perfectly, but consistently enough that when the dollar rolls over, metals rarely wait for confirmation. More currency chasing the same real assets. The result was predictable. The last time the dollar broke down from this region, it wasn't just the chart that mattered. It was the policy response. Massive stimulus, emergency lending, and a central bank that shifted from normalization to whatever it takes almost instantly. Gold moved first. Silver followed. Late, fast, and aggressively. But here's the critical lesson. The biggest gains didn't occur on the initial break. They came weeks later, after fake rebounds failed and the market accepted the new reality. That's why 96 mattered, and why follow-through matters more than the first move. When silver pauses, then surges, it often reflects forced positioning, not exhaustion. That's the difference between a spike and a cycle, and cycles last longer than most expect. Previously, the dollar slid from the mid-90s toward 90 over several months. During that window, gold climbed steadily, silver exploded. History doesn't repeat exactly, but it rhymes. Now here's the real cliffhanger. If the dollar revisits that path, and metals respond even partially as they did before, the next leg isn't fantasy, it's a scenario. What happens if 90 doesn't hold? That level marks the shift from temporary weakness to structural change. And when that happens, psychology changes for savers, institutions, central banks, and eventually consumers. Below 90, the conversation shifts. Zoom out globally, and you'll see why there's no easy escape. Europe wrestles with uneven fiscal realities. The UK has learned how quickly confidence can evaporate. Japan's yield structure has distorted markets for years. When multiple currencies strain simultaneously, capital stops choosing paper. It chooses what exists outside the system. And that's why silver wants a seat at the same table. Now, layer industrial demand on top of monetary demand, and things get unstable fast. That's when price behavior becomes erratic. That's where gold has always lived. If the dollar drifts into the high 80s, life doesn't end. Cards still swipe. Paychecks still land. But trust erodes at the margin, and margins drive markets. If it slides further, prices adjust. Not catastrophically, arithmetically. And before anyone jumps to extremes, confiscation, bans, chaos, slow down. History usually begins with incentives, regulations, and pressure, not force. That's why metals matter. They don't require belief, they simply exist. Confidence drains before panic arrives. Inflation punishes savers quietly. Silver, in particular, sits at the crossroads of money and necessity. It's embedded in infrastructure, electronics, power grids, and data centers. And unlike gold, it's far less liquid. That's why silver doesn't rise smoothly. It lurches. Volatility isn't chaos. It's uncertainty trying to find equilibrium. So what do? We plan. Gold and silver can continue higher if the dollar weakens. But the path won't be smooth. Silver will test your nerves. That means process matters more than prediction. The miners are offense. Balance wins games. The metal is defense. Mining stocks add leverage and risk. They amplify gains and magnify mistakes. They're businesses, not metals. Costs, politics, dilution, management, all matter. Don't fall in love with tickers. Fall in love with process. Watch balance sheets, watch dilution, watch jurisdictions. That disconnect can be opportunity or warning. Some miners lag because investors don't trust the move yet. Others face rising costs. And generalist capital hasn't fully arrived. Gold absorbs flows. Decide how much physical you want. Manage the ride. Silver overreacts. The dollar story isn't finished. Weak bounces matter. Failed rallies matter. If old support doesn't return, pressure builds. Decide how much leverage you can tolerate. Diversify. Plan exits. And do you prefer physical metals or leveraged miners? Do you think the dollar holds 90 or breaks? So I'll leave you with this. And remember, silver's story isn't just price, it's availability. Don't chase. Build on pullbacks. Reduce risk on strength. Drop your thoughts below. This is education, not advice. Do your own research. Think in scenarios. And only take risks you can live with if the market moves sideways before it moves your way.